Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to kick off Q2 earnings. We've had a pretty exciting couple of weeks in the markets. Markets are at all-time highs despite economic numbers not quite pointing in the same direction. We've already had some early reports on the earnings season. So today we're here to talk about, number one, what we're expecting to see out of Q2 earnings going into Q3. And most importantly, talking about how to actually trade them utilizing options. More importantly, how to trade these strong directional moves in with limited risk. And that's really the key area of why we want to use options for trading these types of directional moves. And we really want to talk about some of the sectors and symbols that we're keeping an eye out on based on early reports, based on what trends we see in the markets. And provide some trading opportunities for you guys to take a look at and show you how to utilize OptionsPlay to analyze them so that you can ultimately find these ideas and trade them yourself. So let's go ahead and get started here. Before I do, just a quick reminder for everyone, for those of you that are brand new to OptionsPlay, you can sign up for a free trial here using this link. I will send everyone the link here in the chat window. For those of you that do not have access to this platform, membership is just $75 a month or $500 a year. And if you sign up, you're going to get a free 12-step options trading course to help you jumpstart your options trading, especially if you're brand new. I highly recommend you to take a look at that. It really walks you through a lot of the use cases of OptionsPlay, and more importantly, different option strategies so you can learn how to go about doing that. Included with that is weekly educational webinars like the one that you're on here today, as well as daily options trading ideas so that you can take some of the ideas that we have, see how we leverage options to trade those ideas, and it's a great way to learn how to go about getting started. So with that, let's go ahead and get started here. I'm going to try to go through the slides as quickly as possible so that we can spend more time going through some symbols. If we have time at the end, we'll do a little lightning round so that you guys can submit some symbols, and we'll all take a look at those using OptionsPlay. So we're going to kick off today talking a little bit about what the Q2 earnings season is going to look like. So we're going to do a little preview of that. We'll also do a quick recap of what we saw in Q1, because a lot of times those are some of the things that provide us with some insight as to what we're going to expect in Q2. Then we're going to talk about what option strategies are suitable for trading these earnings seasons. And the key thing about learning about option strategies is the fact that you want to be able to take these directional views with limited risk. So we're going to go over 2 strategies that allow you to do that. Then we'll talk a little bit about why you should even consider trading earnings. And keep in mind that trading earnings is not something that's for everyone. It is, generally speaking, a little more risky than trading when there's no earnings coming up. So we want to define your risks and make sure that you understand what risks you're taking when you're trading earnings so that you can decide for yourself as to whether this is the type of trading that's for you. Not every, there's lots of different types of trading that we go over here at OptionsPlay. Not every single one of them is for everyone. So we really want to make sure that you understand the risks. And once you do that, then we're going to talk a little bit about how can you trade earnings effectively, meaning how can you deploy your capital efficiently when you're trading earnings with limited risk. And we'll wrap this up with live examples, going through some opportunities that we see in the markets from the trends that we're going to discuss here today, pull up some symbols that we think are interesting, that we think have potentials for moves in the upcoming earnings season, and then show you what type of returns you can expect and what type of risks you would have to take some of these trades. So let's go ahead and get started. We're going to start off by talking a little bit about what we saw in Q1. So Q1 was a bit of a shift from the last few seasons. For those of you that have been with us for a few years, we do this earnings season webinar every single quarter at the beginning of every single earnings season. For a long time, things were very, very similar. We basically had strong growth. Both earnings, top line and bottom line were growing, but Q1 was really where we started to see some of that sales sales and earnings per share growth slow down. We've actually had the slowest growth since 2015, but they were still positive. So things haven't turned around. They're just slowing down. But because of that, we actually saw slightly above average earnings in Q1, which is why we are near all-time highs as far as the market goes. So I think that is in line with what we're currently seeing with the markets. We did see optimism fall to an all-time low from the commentary that these companies were pushing out, the guidance that they were saying afterwards. So that was one of the concerns that we had, in Q1. And what I think is most important of all is just the sheer numbers that we saw. And I think the number that makes the most that is worthwhile to take a look at is the reactions that stocks actually had going into Q1. What we saw was very muted positive gains. So on stocks that beat their earnings, we saw very little increase in share price as a result of that. However, on the flip side, stocks that missed their earnings had huge negative reactions. So we were seeing on average about a 1% move to the upside for stocks that beat, but about an 8% move to the downside for stocks that miss. So that's an 8-to-1 skew in one direction. So that provides, from our perspective, a lot of opportunity. And when we look at Q2, we really see this as kind of a deja vu moment, because a lot of things that we saw in Q1 we're still expecting to see in Q2. So growth has certainly decelerated again going into Q2. We have significantly lower estimates going into Q2, which does mean that the bar that to beat these on earnings has been lowered. And that's exactly what we saw in Q1. We saw going into Q1 earnings, commentary and everything where guidance was being revised lower, so there was an easier chance for these stocks to beat. And so we're seeing those same trends going into Q2. So we're continuing to expect muted positive gains, but we're starting to expect huge negative reactions, and we're already seeing that from some of the early beats. So if you look at JPM, Bank of America, some of these stocks have all beat their earnings, including Pepsi, but these stocks have not had any big moves to the upside. But stocks that missed, think about stocks like Netflix, some of the industrial stocks like the railroad stocks. When they missed, we're seeing 5-10% moves to the downside. And this is actually where I think is the biggest opportunity in Q2, is looking for stocks that have a high probability of missing and maybe seeing some big reactions to the downside. So we have some symbols that we want to take a look at for that here today. So if we look at the early reports of stocks that have reported up until now, we're seeing weakness across industrials and energy and materials. I think these are the three sectors that we want to focus our attention on going into Q2 earnings. So that's what we want to take a look at here today. So that's a quick overview of what we saw and what we expect to happen. So with that, what we wanted to look at is which sectors scanned in terms of had the highest upward revisions, meaning has the have a higher chance of beating, and which sectors do we see some of the worst downward revisions. So on the upside, what we're really looking at is real estate, healthcare, and consumer staples seems to be scanning quite well. These are the stocks that if you own will likely beat on earnings, but stocks in the industrial, materials, and energy sector are likely going to miss. So those are the sectors that we're generally going to focus on. But again, on the stocks that beat, we're not seeing that big growth to the upside. We're really seeing a lot of those trade flat after beating earnings, but the stocks that miss, they are having some huge moves to the downside. So those are really the opportunities that we're trying to seek here out today. So what are trading earnings, and why should you trade earnings? So number one, just for those of you that are brand new to trading, earnings is really when the company reports their revenue, profits, and provides some forward guidance as far as what they expect to see in the next coming quarter and the next year or so. And this provides what is a binary tradable event with extreme amount of volatility. And generally speaking, we don't think of volatility as a good thing for traders. However, if you are trying to take advantage of that volatility, if you're long volatility and you want the stock to move, that's really where you can have a big move in a very short amount of time, effectively instantaneously. So once a company reports its earnings, the stock price will react instantaneously to that, and you get a big move in one direction or another. So how can you actually trade this, or how can you take advantage of this? And the rule of thumb here that we use is that if you're going to trade earnings, let's just say for an example that you have a 55 or 60% chance of predicting the move in the right direction, which still means that you have a 40 to 45% chance of being wrong on the moves, then that's why we really want to utilize options to trade these moves, because options provide you to take the directional view so that if you're right, you're going to make a leverage bet on the directional move. But if in the case that you're wrong, you have limited risk, and only options truly provide you with that type of protection. If you're long or short the stock and you have a stop loss on it, if the stock gaps higher overnight, that stop loss does not protect you to the same degree that an option would. So that's why we always utilize options to trade these earnings. And when we trade options, generally speaking, when we're talking about expiration dates, we generally want to pick expiration dates that are at least 2 weeks beyond the earnings date. And the reason for this is because of the fact that typically after an earnings beat or miss, the stock will usually continue to trend in the direction of that beat or miss for a few days, many times a week plus. So you need to make sure that you give yourself a little bit of time beyond the actual earnings date, because many times you see that drift that happens afterwards. So choosing an earnings date that are at least 2 weeks out gives you a little bit of buffer time, so that if the move happens, that you're able to still continue to take advantage of that directional move for a period of time. As far as strategy goes, generally speaking, buying call and put options are a good starting point as far as a strategy goes when it comes to trading these earning strategies. So buying calls or puts is one of the strategies we'll go over here today, but we'll also talk about some other strategies as well. So before we actually talk about the strategies themselves, it's really important to actually understand option pricing around earnings, because there's a lot of things that move around earnings, and it's important to understand how those things affect your option price, because the option price is really what allows you to either make or lose money on your bet. So it's really important to make sure that you understand what things are actually impacting your option prices around earnings, because it's a little different than if you're not trading around earnings. So the reason trading earnings is typically a little bit difficult is the fact that I call this 1 step forward, 2 steps back, meaning you only actually have one thing potentially working in your favor, while you always have 2 things that are constantly working against you when you're trading earnings. So when you trade an earnings event, you have to first pick a direction, either a beat or a miss. So if you expect a beat, you're trying to take a bullish view on that stock. If you're expecting a miss, you're trying to take a bearish view on that stock. So number one, you have to choose one of those 2 scenarios. So this is where you're basically making a bet on the direction that the stock will either beat or miss. That's the potential for making money if you call that direction correct. However, while you're doing that, there's 2 things that's working against you. First of all, there's what we call a volatility crush. Volatility crush is really the fact that before earnings, there's a lot of uncertainty, and that uncertainty is built into the price of the option. So buying a call or a put going into earnings is generally going to be very expensive, because there's a lot of uncertainties of what's going to happen. So in order to protect against that, people are going to demand a higher premium to sell you that call or a put. So once the earnings announcement comes out, that uncertainty factor goes away, and now all of a sudden calls and puts will become much cheaper because the event has happened. There's no more uncertainty. Those calls and puts will automatically become cheaper. So that decrease in implied volatility will decrease the price of your option, and that's a volatility crush that we're going to talk about. And lastly, because of any long option that you purchase, or any call or put, whether you have earnings or not, you always have time decay working against you. And that's the same when you're trading around earnings. So as you're trying to bet on the stock moving in the direction, and that may work in your favor if you call the direction correct, during that time, volatility in time is working against you. So you have two factors working against you, with one factor potentially working in your favor if you call it correctly. So in order to profit from trading earnings, number one, you need to have not only the directional move correct, you need to have a large directional move that overcomes the volatility crush and the time decay. So the volatility crush and time decay are working against you. A large stock move is what's potentially moving in your favor, and that's what you have to, and the move has to be large enough to overcome the volatility crush and the time decay. So for those of you that are brand new to options trading, that might be a little confusing, but that's why I have the next slide, because that's where we're going to talk a little bit about the Greeks. Now, I'm going to bring up the Greeks to help everyone understand from a conceptual perspective how to actually calculate these three factors that I'm talking about. However, you don't actually have to do any math, and you don't have to you certainly don't have to learn the Greeks, because OptionsPlay calculates these parameters for you. So this is, again, the slide that's meant to help you guys understand the concept. You don't have to memorize this. You certainly don't have to know how to do the math. But we talked about the stock price potentially working in your favor or against you. That's what the delta of an option tells you. The delta tells you the change in the price of the option with respect to the change in the stock price. So if the stock price was to move $5 in your favor, how much money does the option actually increase in value so that you can profit from that? So delta will help you calculate the gain that you will gain or loss in the underlying option that you will have based on a percentage move in the underlying stock. So if you see an option that has a delta of 0.5, that means for every dollar that the stock moves, the option will move 50 cents, by half as much. So that's how you measure how much gain or loss you have on the underlying option based on the change in the stock price. Now but like I said, while that happens, while that works in your favor or against you, depending on whether the stocks goes in your favor or against you, volatility and time decay is constantly working against you. So Vega is what we use to calculate the change in the price of the option with respect to the change in volatility. So if you see an option with a Vega of 0.25, that tells you that this option will lose 25 cents for every 1% change in implied volatility. So we're going to talk about that in a few minutes using OptionsPlay to show you how you actually see the changes in volatility. And lastly, for time decay, theta tells us the change in the price of the option with respect to change in time. So if you see an option with a theta of 0.1, that's telling you that this option will lose 10 cents for every day that you hold on to it. So if you hold on to a trade for 2 weeks, then you should expect this option will erode by roughly $2. So those are the three very important metrics to make sure that you're familiar with and aware of, because these are the three things that will most likely impact your option price around earnings. So again, I don't expect anyone to memorize these formulas or know how to calculate it, because OptionsPlay does the calculations for you. So now let's move on to the actual strategies that you would utilize to take these directional moves. So number one, long calls and puts is a simple yet very effective strategy for trading earnings, because they give you unlimited profit potential if you call the direction correct. So if you are buying calls because you are bullish on a stock, that will allow you to, let me use this arrow. If you buy a call option, that's because you believe that the stock will go higher. That will allow you to provide a unlimited profit potential when you expect big moves. Now, this generally will put a larger amount of capital at risk. However, these strategies have limited risk. So no matter what happens, you have a limited amount of money that you can lose. Conversely, if you buy a put, that's if you expect the stock to drop in value. So very clear, very simple strategy to speculate on a directional move with limited risk. The second strategy that you can utilize is a call vertical or a put vertical. This also gives you limited, unlike the call or a put, which gives you unlimited profit potential, a vertical will have limited profit potential. And this is generally useful more so for when you expect a modest or slower move on earnings. So long call verticals and long put verticals tends to be better for, in my opinion, bullish moves, versus puts tend to be better for bearish moves. And the reason for this is, again, because of that first slide. We talked about when stocks beat earnings, they don't make these huge moves, jumps to the upside. They tend to have more muted moves to the upside. So because of that, these verticals, which put a smaller amount of capital at risk, and are generally speaking better for a modest move with limited profit potential, will give you a better return than when you expect a big move to the downside. When you expect a big move to the downside, that's when buying a put sometimes it might be better, because that allows you to really take advantage of unlimited profit potential to the downside. And again, just a reminder, when you're buying these types of strategies, you want to pick expirations that are at least 1 to 2 weeks beyond the actual earnings date of the stock. So those are the few examples, a few strategies that you might want to take a look at. I think the best way to actually show this to you is actually using OptionsPlay. So with that, what I'm going to do is I'm going to jump over to OptionsPlay. I have some ideas to show everyone, and looks like I still have plenty of time today, so it looks like I'll be able to go through a few different examples and then open this up for you guys to submit some symbols to take a look at. So first of all, like I said, right now we see more opportunities as a downside, because if you look at stocks like Pepsi that beat earnings, notice how there's really no big moves to the upside. I think the only real notable earnings beat this quarter so far has really been IBM. That's up about 5% on its recent beat yesterday. Everything else has really either been flat or massively down, like Netflix, down 10%. So those are the things that we're looking at. So we do think that there's more opportunities to the downside. And if we look at stocks, if you look at industrial stocks, they've really taken a hit over this quarter with the whole trade wars. Stocks have really shown a lot of pessimism, are the industrial stocks, energy stocks. So those are some of the ones that we want to pay attention to and take a look at. So I'm looking at Hess here. I'm looking at Hess because it's actually one of the energy stocks that have recently crossed below its 50 and 20-day moving average. Notice that the 1 month and 6 month trend just started to turn bearish here yesterday. So these are all indications that for me that this stock may continue to move lower. This stock reports earnings on July 31st. So what I'm going to do is I'm going to take a look at some bearish opportunities here, so I can short the stock, I can buy a put, I can buy a put spread. Let's just take a look at just the straight put for a second. So we talked about two things. One, you can expect, let's just say right now this stock's trading around 59 or so, 60 bucks or so. Notice that the low here is around 54 bucks or so. So I think that if this stock was to miss on earnings, $54 is probably a reasonable target. So what I'm going to do is I'm going to use my P&L simulator. I'm going to enter $54 as a target price. I'm going to enter the date just a few days after the earnings date. So on July 31st, so maybe here on August 5th or 6th or so, a few days after earnings. And the last thing I'm going to do on the P&L simulator, like I said, volatility is going to come down after earnings. So it's important to also adjust the volatility slider going into earnings. So currently the implied vol of Hess is around 33. I'm going to move this down to about 24 or so. Usually I like to go halfway between where it currently is and the lows, and that gives me a pretty good indication as to roughly where vol would be. And as you can see here, if the stock was to plummet to 54 on a miss a few days after earnings and volatility comes down, I'm going to make about 113% return on my put. So costing me $284 to make a bearish bet on Hess moving lower. I'm going to make 113% return on that if I am right. And if the stock doesn't move anywhere on earnings, as you can see, I lose about $118 out of the $284, so I'm roughly losing about 40% of it. So from my perspective, if the stock doesn't move around earnings, I'm risking 40%. If the stock does move to the expected move, I'm making about 116%. So roughly about a 3-to-1 risk to reward ratio. But if the stock does rally, which it's possible, but I would say the risk of that is relatively low, I'm risking about 87%. So I'm still having about a 1.5-to-1 risk reward ratio on a trade like this if I'm right versus wrong. And conversely, if the stock does go down to about 54, the spread also gives me a pretty nice 128% profit, because instead of costing me 284 to make this bet, it only cost me 221. So this is really where you can utilize OptionsPlay to model out different scenarios. But the two things that you can't control is time and volatility. Those are the two things that you have to generally set. Then you can play around with the price slider to see how much money do you make if you're right, how much money do you lose if you're wrong, and then decide if those risk reward excuse me, and then decide if those risk and reward ratios make sense for you. So again, I'm just today mostly going to look for some bearish opportunities, because again, that's what we're currently seeing in the markets. When the markets are near these all-time highs, this late into the business cycle, it is very, very common to see that stocks that beat do not have big moves to the upside, but stocks that miss seems to have big moves to the downside. So we want to look at sectors that are missing on earnings. So if you look at industrials, they've really tanked on earnings. So we're going to do the same thing across some industrial stocks like 3M here. 3M recently is just trading around this kind of triple top at 175 or so. So let's take a look at some bearish trades. This stock reports earnings in 5 days on July 23rd. So again, I'm going to select a date a few days after earnings, so maybe July 30th. I'm always going to have to select my volatility slider down a little. And as you can see, this stock's currently trading at 175. It's been trading within this 160, 175 range for a while. So if I do expect a miss, I would expect to see this revisit around that 160 level or so. So as you can see, if it does that, first of all, to take this bearish bet will cost me $725. Here is a 110% return on that bet if the stock does decline to about 160. And these are the types of moves that we're generally seeing on these big misses. And to the flip side, if the stock stays where it is, I'm risking about a third of what I'm purchasing. And if the stock does rally higher, then I can see exactly how much money I'm risking. So this recent high was around 187 or so. So if it does reach 187, I do risk pretty much everything here, but my upside is slightly more than that. I think it's about 116, 115 or so return on this. So this is really where I can utilize this tool to very quickly understand what my potential risks and my potential rewards, as long as I make sure that I use the time slider correctly and the volatility slider correctly. And those are two things, again, that we cannot control. The only thing we can control is whether we take that directional bet, either in a bullish or bearish bet. And you can always flip this. So you can say, I'm going to flip this to a call instead of a put if you're bullish, and utilize the same settings to say, well, if the stock was to move higher, how much money would I potentially gain, versus if the stock moved lower, how much would I potentially lose? And this is really why we created OptionsPlay, so that you can easily flip between bullish and bearish and trade both sides and very quickly look at the opportunities. Because sometimes we might look at a stock in a different view depending on our views on the different sectors. So you may completely disagree with us on certain sectors. You might believe that energy is starting to turn around. Oil prices are going to start moving higher. And if that's the case, you might want to take a look at some bullish ideas on Hess or Halliburton, which is one of our bearish ideas from yesterday. So lots of different opportunities that this platform provides you with. So what I really want to do here today is just show you how I use this platform. make sure that you understand what things move around earnings so that you can utilize this platform for your own ideas. So next, what I want to take a look at is UPS. This again is in line with what we're currently seeing with transportation stocks that have really taken a hit going in the early reports this season. So UPS certainly in that category, similar to CSX, the railroad stock that really took a beating yesterday. So this stock reports earnings on July 24th. So if let's say I'm bearish on UPS, a very neutral stock, this stock recently had a low around 97 and 92. So I think those are some first and secondary targets to a downside move. You know, we've already started to have this break to the downside yesterday. So if this stock was to move lower a few days after earnings, so earnings is on July 24th, so if a week later on July 30th, volatility comes down a little, and we said that if the stock was to move to about 97 or so, which is that first target, notice how things don't look as rosy. So it's going to cost me $440 to make this bet. I'm only going to make a 48% return if UPS falls to about 97, this last swing low. If the stock moves lower to about 92, 93 level, which is where it was in the beginning of June, that's when things start to look really interesting. So you can ask yourself, you know, do I think UPS can potentially move down to about 92, 93? You know, this stock is trading at a fairly rich valuation right now, 19 times earnings for a transportation stock. And, you know, can it move down to 93? If you do believe so, this certainly looks like an attractive trade, while risking about 40% of that underlying if the stock does not move to the upside. So again, this is really where, you know, I think we can be fairly conservative to say, even if the stock beats, it's not going to move substantially to the upside. So if it does move a little bit to the upside, I'm risking roughly 2/3 of what I'm paying on this particular trade. But if I am right, I'm going to make roughly double that. So this is really where the risk reward ratio, I think, for puts on this particular earnings season makes more sense than looking at calls. So with that, you know, I'll just pull up one more example before I open this up for you guys to submit some symbols for us to take a look at. I was looking at Tesla here. You know, Tesla's really had this huge run up since June. I'm not sure that fundamentals have changed very much on this particular company, and it's just trading around this major resistance level around 260. If you look back even further, 260, as you can see, was support right here in early March, support again in early April, mid-April, finally broke above it, came back to that 260 level and just sold off heavily. So I think 260 is a pretty major line in the sand, and we're just right back at it 6 days before its earnings. So I'm not necessarily that bearish on Tesla, but just from a technical perspective, this looks like a pretty clean opportunity to short because I see a lot of downside targets, you know, a lot of room to the downside. And as long as the stock trades back up to about 275 or so, I would say I'm wrong on this trade and get out. So here, as you can see, if the stock a few days after earnings, so let's say again, July 31st, its current volatility is pretty high. So let's adjust this down to about 40%. And if this stock moves down to, let's say, this 207 area, 207. As you can see, I'm looking at 156% return on my $1,800 risk on this particular bearish trade. And if the stock stays where it is, I'm risking 35%, a third of that. And if the stock does beat to the upside, let's say it moves all the way up to 275, which was the level I was talking about here before, I'm risking 76% of this 1865. So versus, you know, if I am right on this trade, making about 156, more than double that. So those are the types of risk rewards that I certainly like to see on these types of earnings plays. And you know, if the stock moves up to 275 even before earnings, I would probably get out. And so if let's say a day before earnings, the stock is at 275. then I'm risking 70% of this particular trade, but actually volatility will still be higher. So I'm only risking half as much. So, this is really where I'm risking half the amount of money to try to make triple that if I am correct. And this is really how you can utilize this tool to really model every possible scenario. Whether you're thinking about a move happening before earnings or you're trying to capture an earnings move after earnings, this tool is designed to allow you to easily adjust for the different time frames that you're expecting a stock to move in, and then using the P&L simulator to quickly get a sense for what are your potential gains and what are your potential losses. So with that, what I'll do is I'll open this up for Q&A, and I'll open this up for those of you who want to submit some symbols for us to take a look at with stocks that are coming out. Let's see. Fred's saying, try trading earnings a few times and always lost due to volatility crush. You're absolutely right. This is why I always say trading earnings is one step forward, two steps back, because you always have that volatility crush. So the best way to understand that is to model it out before earnings, because some of these trades that I've done, that I'm showing you here today, I've already pre-scanned them and I've looked at them and they look good, but I don't know what stocks that you're looking at. So, looks like there's a few different requests here. So BIIB is one of them. So let's take a look at that. This stock reports earnings in 5 days. Actually, when you submit a symbol, please tell me if you're bullish or bearish on it so that I can take a look. But BIIB, this was one of the stocks that we were bullish on in our credit spread trading system. It did not work out. It's really starting to turn lower. The trends have started to turn lower yesterday. It came back a little bit today. Hard to say where this is going to be going into earnings. But let's say you're bearish on the stock going into earnings. A few days after earnings, which would be around July 29th or so, volatility comes down. I don't know what your target's on this, but I would conservatively target about this 220 area on BIIB to the downside. And as you can see here, not a very good return, only a 29% return. I would not be taking this type of bet for a 29% return. You would really have to make, 220 I think is that last swing low, right? So I mean, that's the range low here is about 220. So even if it moved down to 215, which is the absolute low, you're still only looking at 66%. So this is not a particularly great attractive trade for me. Even if I was bearish on BIIB, these puts do not make a lot of sense for me. Looks like I've got one here for Etsy. You are bearish on Etsy. So let's see, Etsy's trading just around $63 or so. Trends just started to turn a little bearish here. Looks like it popped up higher today to about 65 or so. And you're bearish on this reports earnings on August 6th, sorry. So if let's say a few days after earnings on August 10th or so, the stock moves down to about 59 or so, 58, which was the prior lows, and volatility comes down. Notice that the put vertical is okay at 85. This one's at 68. Not as attractive in my opinion, because you are risking about half the amount of the trade if the stock does move marginally higher on earnings. While even if it does move in your favor, you're looking at roughly the same amount in terms of gains. So it's a bit of a wash here. The risk-reward ratio is not very attractive. It's certainly something that you can take a look at, but nothing that jumps out at me as very attractive. Brian is bullish on Microsoft. We also have a bullish trade currently going on with Microsoft. We have a vertical spread. We already have this earnings play on. So let's say you're bullish on Microsoft. You would really need a big move to the upside to new all-time highs. This reports today. So actually it might have actually reported already. So I will say that this is too late because markets have closed already. I haven't looked at the markets since we've started this, so I don't know where that earnings will be. So I don't think Microsoft unfortunately is too late for us to take a look at. Please try selling a bear call spread for Tesla. So here's the thing about trading credit spreads on earnings. So the reason that we don't recommend selling credit spreads on earnings is because you have it's the risk to reward ratio is completely screwed up on a credit spread. So let's take a look at a bear call spread on Tesla. So here's what I would normally do. I would do usually about a 29-day. So we would sell an at the money strike. So an at the money would be about a 250. Let's just call it a 255. We'll buy maybe a 280. So this would be the type of credit spread that I would typically trade here. I'm risking $1,600 just to make $900. Not worth my while, because if this stock really does tank to about that 207 level, let's do this. A few days after earnings, volatility comes down, and let me just make this all apples to apples. Let's say I'm willing to risk, and I'm only putting $10,000 because this is a high price stock, just to show you guys apples to apples. So if this stock was to tank to about 208, if I'd sold this bear call spread, I make $5,400. If I bought this debit spread or I bought this put, I make either $14,000 or $16,000. Risking the same $10,000, would you rather make $5,000 or would you rather make $14,000 and $16,000? So clearly, when you're trading these types of earning seasons, these types of binary events, right? You want to risk the least amount of money to try to make the most amount of money, because at the end of the day, no matter how good of a trader or investor you are, I think you might have about a 60% shot of calling these beats or misses correctly. And if you're going to call it 60% of it correctly, you don't want to risk $10,000 just to make $5,000 when you do call it correctly. You want to risk $10,000 to make $14,000 or $16,000. That's why it doesn't make sense to sell credit spreads going into earnings, because you have a negative risk reward ratio. Even if you call it more times correctly than not, you're going to risk more money than you're making when you do call it correctly. So from my perspective, not worth selling credit spreads going into earnings. Adrian's asking, what happens if your option expires and is still worth dollar amounts? So you would want to close out that trade prior to earnings. That would be my suggestion to you. So I've got a lot more requests here. Let me go through a few more of these, and then what I'll do is I'll come back to all your questions. RESN, I'm not familiar with this stock. So this is certainly a weak stock with 1 month and 6 month trends are bearish. So I would certainly have more of a bearish tilt on this. This reports earnings on August 13th. I unfortunately do not really have a view on this per se. Ike is asking AMD. AMD is a very strong stock. This is actually might be one of, semiconductor stocks actually is one of the highlights of this season in terms of stocks that are actually reporting higher. So I think Taiwan Semiconductors reported higher yesterday. So, these types of stocks I think are the only stocks that have this potential to move to the upside. This reports earnings in 6 days. So if we look at volatility coming down a few days after earnings, and this stock jumps to, let's say, I don't know how far the stock can go, 37, 38 maybe. This does look pretty attractive here, about 100% return versus about a third loss if the stock stays where it is. And then, excuse me, and then risking maybe about 2/3 to about 4/10 about that if you are wrong. So, slightly about 1.2, 1.3 to 1 risk reward ratio. So still positive. Eric is saying he's neutral on Apple. That's an interesting one. So neutral on Apple. That would, going into earnings, neutral on Apple. I'll throw a crazy idea out there. This is really where selling a straddle sometimes makes sense. So, or maybe even a strangle, maybe a slightly wider strangle. Those are sometimes better for when you have a neutral view. I would sell maybe a 30-day strangle. So this trading's at 205, so about 201, 210. And as long as the stock stays well within this range, this reports earnings on the 31st. On the 30th, volatility comes down. The stock stays where it is, as you can see here. This strangle will make a nice profit. But that's the only strategy that I would use selling a strangle around. If you don't have the ability to sell strangles, you can trade a condor. So something like a short iron condor might be suitable. That would be really the only time, in my opinion, that's suitable for trading an iron condor. Brian's bullish on Microsoft. Again, too late on Microsoft. Kelvin is bullish on Amazon. So I was actually looking at Amazon here today. You know, people have different views. You know, I think Amazon may have the same fate as Netflix. That's just my own personal opinion. That is not a recommendation to go bearish on Amazon. But Kelvin is bullish on Amazon. So let's take a look at that. So Amazon reports earnings on July 25th. So let's say a week afterwards, volatility comes down. I don't know how far you think this stock can go. You know, all-time highs is at 2050. So let's say it goes back to up to 2050. Notice a 32% return, not very particularly attractive while risking $7,300. If you really think this can blow it out of the water, like to 2,100, even at 2,100, you're only talking about an 84% return. So from my perspective, limited upside. But I think there's far more potential moves to the downside. So it's an expensive trade. So, you know, I was looking at this, I was trying to figure out how I could trade Amazon for a much cheaper way. And one of the ways that I came up with was, again, a few days after earnings, volatility comes down. I was looking at, instead of buying these types of verticals, what you can do is you can really make the vertical very narrow, but move it very lower. So, and I wouldn't go all the way out to August. I would maybe do August 16th. So instead of making you can make your vertical much wider, narrower, trade maybe, let's say what's this, a 30-point vertical for about a third of the width. And if you do get that big move to the downside, so let's say this stock moves to about 1830 or so, as you can see, I'm looking at about 174% return if I am right. This was just a crazy idea I threw out there, you know, thinking about if I was to trade Amazon, how can I do it without having to shell out, you know, $7,000, $8,000 for a vertical spread or a put option. And this is one way that you can potentially do it. It's a very unconventional way, I will say, but it is some way that you can take a look at it. Paul's asking for CGC. He's bullish on it. Canopy Growth. A lot of marijuana stocks have really taken a beating over the last few months. Paul is bullish on this. So I don't particularly have a view on this industry as to whether I think this is going to bounce higher or not. But if you do get a bounce, I think 39.42 would be some lines in the sand that I'd be looking at. So this reports earnings. I actually don't have an earnings date on this, but if it reports earnings here around here and the stock jumps up to about 39 or 42, even at 42, notice how even if the stock jumps all the way back up to 42, which I think is a pretty big move to the upside, you're only looking at about an 89% return on here, where you're probably going to be risking roughly the same amount if the stock does decline. That's where I don't think the risk to reward ratio on this trade makes that much sense. James is looking for VIV. I also am not familiar with this stock, so I don't have much to say on this, unfortunately. Spencer is bearish on USAT. USA Technologies. Sorry, I also don't have much on that. Disney, let's look at Disney. Disney reports earnings on August 6th. This stock is at all-time highs. Let's say you do expect this stock to continue moving higher, and this is one of those stocks that have really just defied gravity and continues to move higher and higher. This stock reports on August 6th, so let's say a few days after earnings, volatility comes down, and you know, let's say we do get a move up to 150 or so. You do get about a 90% return to the upside, which is okay. And if the stock stays where it is, you're risking about half of that. So you have almost a 2-to-1 risk reward ratio. So that looks pretty good. So with that, you know, that I'm unfortunately out of time here from looking at more symbols here, but I hope that what I'm able to show you guys is just how easy it is to utilize this platform to pull up a symbol, make sure that you adjust the time frame and the volatility slider, and then you can utilize that price slider to see what are your potential rewards, but more importantly, what are your potential risks on every single trade, because that's really the most important thing to understand on all of these trades, is to make sure that you understand your risks before you look at your potential rewards and see what that risk reward ratio looks like. If it's skewed to the downside, meaning you're risking more than what you can potentially make, probably not an earnings trade that you should make. If you are potentially making 150, 200% return while risking 50 to 75% of that trade, that's when that's when it might be worth your while. So I just want to thank everyone for taking the time out here this afternoon. What I'll do is I'll scroll up now and take a look at some of the questions that you guys have asked and try to answer as many questions as I have time for. So if you have any more questions, please type them into the chat window or the Q&A window, and I will answer as many questions as I have time for here. Hi, Tony. I'm a little confused about call and put vertical and debit versus credit spread nomenclature. Please clarify if time allows. Great question. So we actually have a whole video on that, and I highly recommend you to take a look at our YouTube channel, which I will send everyone a link here. I actually have a video just on credit versus debit spreads, and I highly recommend you to take a look at that. I will post that video in the chat window. That's where I talk about understanding what vertical spreads are, and more importantly, what the difference between debit versus credit is. Bradley's saying, it seems like volatility crushes the extra variable during earnings season that works against us. In past webinars, it was mentioned that trading options during earnings could be difficult. When, in your opinion, does trading earnings become beneficial since the op seems more against us? It's never going to be in your favor. It will always be going against you. But this is the one time when you get these big moves. So days like yesterday when we had that huge 10% move in Netflix, if you had bought a put on Netflix, even though that volatility crush is working against you, you would have made a pretty penny on Netflix literally instantaneously. So those are the opportunities that earnings players are chasing. And what we're trying to do is show you where to look to potentially look for those potential opportunities. And right now, industrials and energy stocks are the ones that seem to have the highest probability of making those big moves to the downside. Where does it show where earnings is? It's right here at the bottom of your screen below your chart. What happens if the options expire and it's still worth some amount? So Adrian, if the option is still worth something at expiration, that's when you want to close out that option at that premium. That's what will allow you to close it out either at a profit or a loss. Does OptionsPlay score a risk reversal option strategy? Your thoughts on this strategy? James is asking about what we call a finance vertical, or what other places call a risk reversal. We absolutely do. So I don't know if you're referring to a risk reversal from the perspective of a what we call a finance vertical. Here, let me just see if I can find that. A finance vertical, which is really just a call spread with a short put. So you can really think about it selling a cash secured put and taking those proceeds to help you pay for a call spread. This is a strategy that a lot of more advanced traders really like to use, especially, but I will say this is only a strategy for stocks that you don't mind purchasing shares of it at a lower price. Because when you sell that cash secured put, you're obligated to purchase that stock at a lower price. So we certainly can score it for you, but I will say it's a more advanced strategy. But the best way to think about it is you're selling a cash secured put and using those proceeds to buy a call spread. So you are basically lowering the cost of that call spread. So if the stock goes higher, you're making a higher return. But if the stock moves lower, you now have to purchase those stocks. So that's a huge risk that not everyone wants to take when you're taking a risk reversal. James is asking, how do you enter iron condors? So I'm not sure what you mean by how to enter them. If you're talking about how to use them on OptionsPlay, the strategy constructor here allows you to construct an iron condor just by the click of a mouse. But if you're talking about how to enter this into your broker's platform, then what you can do is you can click on trade, And what we do is we actually show you all 5 legs for you to enter this into your broker's platform. What is the probability of success? The probability of success is really just the probability of the stock being above or below your break-even price of the strategy at expiration. What is a good risk-reward ratio? So for earnings, you have to look for at least 1-to-1. I would usually try to get for at least 1.5-to-1 on most of my trades. And again, that depends on the levels as to where you think best and worst case scenario of an earnings will be. And that's a bit subjective, I will say. But a lot of times you can look at price history in terms of previous earnings to get a sense for when the stock beats, how much does it move up by? If the stock misses, how much does it move down by? That's one way to gauge roughly what your risk to reward ratio would look like. Charles is saying, how do you choose a stock to start looking at besides the earnings date? Again, I usually use sector to scan for first, right? Because we're following a thesis every single quarter. This quarter, is the fact that trade wars and tariffs have really hurt some of the industrial stocks. Energy stocks have really taken a hit because of lower oil prices. There are a lot of issues in some of the fracking stocks. Fracking is no longer as bountiful as it used to be, and it's costing them a lot more money to get that oil out of the ground. So that's where we're seeing a lot of these types of energy stocks taking the tumble this quarter. So that's our thesis that, that's where we're going to see the opportunity of the biggest misses, and that's how we're finding these types of opportunities. Please advise on Halliburton. I think we've already looked at Halliburton. Margaret is saying, can you please explain the vertical trade on Tesla example you showed? It seems like this might move less. Margaret, if you can clarify what you mean by that, I'm happy to answer that question. Matthew's saying, on the Tesla example date was August 30th, but you recommended in one of the slides to go to an expiration date of 1 to 2 weeks beyond earnings. I was saying in this slide, at least 1 to 2 weeks beyond earnings. So what I'm saying is that I'm not necessarily saying go 1 to 2 weeks beyond earnings. I'm saying greater than 1 to 2 weeks. So that is a distinct difference, I think, that I meant. So anything greater than 1 to 2 weeks is suitable. When do you trade an option before earnings? So generally any time before, or generally 2 to 3 weeks is a good time, is a general time frame. Usually 1 week, I would say 1 to 3 weeks before earnings is a general time that most people enter these types of trades. Iron Condor on Netflix. Well, Iron Condor is really a short volatility play. The volatility crush has already happened on Netflix, so I unfortunately think it's a little late. And it certainly wasn't a great trade if you had gotten into that before earnings, because you would likely have lost money on that Iron Condor. So again, Iron Condor is only for stuff that you have a neutral view on and you expect volatility to come down. So in the example where someone said that they were neutral on Apple earnings, that's really one of the opportunities where you may want to consider selling an Iron Condor on a stock that has earnings and you think is just going to be neutral going into that earnings. Let's see. Also, is there a way you can have, say, a large call position open, but you can't sell it because of low volatility? I mean, if you hold your option up to the expiration date and then expires, what happens to your option? Does it automatically close or roll over somehow? So Adrian, that depends on your broker. Your broker typically has rules in place so that if you have a call option that's in the money, what they will do, usually they may exercise that for you and you will be long the stock, or they may automatically close it out for you. So that depends on your broker. So I would definitely talk to your broker about that. Brian saying, by the way, Microsoft earnings very positive. Great. We're long Microsoft. I hope you guys are too, with the recommendation that we put out a couple of weeks ago. Don is saying, do you view vol crush as working for you when selling vertical spreads, which you plan to close out immediately after earnings? Don, vol crush does work in your favor if you're short a vertical spread, but like I said, when you're short that vertical spread, you're risking far more than what you're receiving on that credit side. So even if you call the right trade 60% of the time, that 40% of the time that you're wrong, you're going to lose more money on delta than you're going to gain on the volatility crush aspect of it. So don't just think about the volatility crush, because the volatility crush, while is working against you or working in your favor, depending on whether you're long or short the option, it's still a relatively small component of your P&L compared to what you make or lose on the delta side. So this is really why I think it's so important to really understand delta, theta, or vega from a Greek's perspective, because the delta exposure that you have on any of these trades is far greater than the volatility exposure that you have, because we're talking about many times your vega might be 10, maybe 0.1, 0.15, versus your delta many times on these trades can be a factor of 2 or 3 times that. So while vega may be working in your favor, you're absolutely getting screwed on delta. It doesn't, look at the big picture. What I'm trying to say is the big picture is really the delta, not the vega. Let's see. Ike is saying, what is the probability of success? I'm not sure which probability of success you're referring to. What is a good risk to reward ratio? Like I said, about a 1.5 to 1 is usually what I'm looking for on these earnings plays. And when should we place earnings trades? Like I said, usually about 1 to 3 weeks prior to earnings. Ferdinand is saying, if you let a call run to the end date, do you have to buy those shares? So that depends on your broker. Most brokers will exercise the call for you. They will actually charge you a fee to do so. So when you're long a call, don't hold them to expiration. And I highly recommend, whenever you're long any options, don't hold them to expiration. Close them out prior to expirations at a profit. Tony's saying, please review profit levels for vertical spreads, i.e. sell at 20% profit or when. So Tony, that highly depends on your whether you're trading a debit or credit vertical. So I actually cover those rules in my video on trading debit versus credit spreads, which I just entered a link for that in the chat window. So please take a look at that video if you want to learn more about debit versus credit spreads. Matthew, thank you so much. I appreciate it. Bradley saying, you have a slide on Greeks. I know the Greeks change dynamically, so wondering if we can rely on delta during earnings and volatility changes drastically. So Bradley, delta will change quite a bit, but generally speaking, delta will change quite a bit as you get closer to expiration. If you're trading something 45 days out and earnings is only 30 days from it, delta is not going to change that much. You can learn more about gamma if you want to, because that will tell you how much delta changes with the change in prices, but delta generally doesn't change very much with the change of volatility. That's if you want to learn more about Greeks, I'm happy to talk to you a little bit more about that. You can send me an email at info@optionsplay.com, which I will send a link in the chat window. Charles is saying, what is your take on trading diagonals to earnings, but out before? So I'm not sure why you would trade a diagonal and get out of it before. If you're going to trade a diagonal, you should trade it going into earnings and hold it through earnings, because that's the whole point of trading that diagonal, to have that short leg, have the volatility of that short leg, be short volatility of that short leg, and be long volatility of the long leg. So it's a more advanced strategy, but if you're going to trade diagonals, you should hold it through earnings. That way you can take advantage of the volatility crush of the short leg. Thank you so much for everyone for participating here today. How accurate are the calculated returns compared to actual results? So James, the calculated returns always have to make some assumptions that things are constant. So we have to assume that certain things are constant, which obviously are not going to be constant, but we can't predict what those things will be in the future. So that's why they are as accurate as our models can possibly show you. But depending on what happens in the future, which sometimes we can't control, just like we don't know what volatility will actually be in the future. So it's as accurate as we're able to possibly model it. Bradley, thank you so much. Nicholas, please repost the links to the video. Nicholas, I've already posted it to everyone. If you want to view our videos, you can go to our YouTube channel. We have all the latest videos on our YouTube channel posted for you. So you can, I just sent the link to everyone in the chat window. Sue, James, Raymond, thank you so much. Any other questions? John is asking, if you have a stock option going into earnings, can you just trade a vertical shown by OptionsPlay recommendation? Absolutely. But use the P&L simulator. See how that vertical will perform, because just because there's a vertical doesn't mean that it will perform based on your views of the market. So if the stock moves up 2%, you can buy that call vertical, but you might actually still lose money. But I couldn't tell you that unless you actually put it in an options play, see what the actual returns would be, and then decide for yourself whether that return is enough for you to take on that kind of risk. Cal, thank you so much. Sue, James, thank you so much. I really appreciate it. Any more questions before I sign off for today? And just so everyone knows, this video is recorded, so you will get a recording after we finish here today. So with that, I just want to thank everyone for taking the time out here this afternoon. I really hope that you guys found this useful and have some ideas to take away from this and start looking at some earnings plays. And please, I will see you guys next week. I hope you guys have a great evening. And looks like one last question. Frank is saying, why did you use directional strategies into earnings? It's difficult to know which direction the stock will go. Frank, as opposed to what? As opposed to having a neutral view going into earnings? So I think I covered that one example of, someone said that they were neutral of Apple, and I was saying that you can sell a strangle if you have the ability to do that. If you don't, trading an iron condor is suitable. So you don't necessarily have to have a directional view. You can be neutral, and that is something that is very commonly traded. Just be aware of the risk. I think you're more likely to see, and you have to identify which sectors are likely going to not move very much. So if you ask me, I think stuff like consumer staples may be, the type of sector that may not move very much this particular earnings season, but even that's hard to say. I think this is the earnings season where we do see a lot of moves, and that's why we're looking at some more directional strategies going into earnings. So I hope that answered your question, Frank, and I, again, want to thank everyone for taking their time out here this afternoon. I really hope that you guys have found this useful. Best of luck with trading, and I'll see you guys next week.